Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Going back to that Tesla story, disappointing quarter, the stock's off 12%. Elon Musk trying to redirect the focus of investors on other parts of the company, AI, robotaxis, and the like. Steve Mann joins us. He covers the global auto industry for Bloomberg Intelligence. Steve, what you make of the quarter last night holistically for the Tesla story?
I still like their long-term, medium-term outlook on AI. I'm not, in our view, we're not including 8 billion Optimus robots. I think that's a little bit out there. But AI will continue to drive the stock. But I think today people are focused on their auto business. It's a little bit worrying. I think investors were expecting their automotive gross margin to flatten out in the second quarter versus the first, but it did decline about 150 basis points to 13.9%, which is in line with the legacy automakers' automotive gross margin of 14%. So there is some concerns with the investors. Are there any more upside on margin? Are they really that good with cost?
But I guess the question is, how do we value the stock? So I hear you that the auto part of their business is very much maybe in line with what other auto companies are talking about, but they trade an estimated PE of like 90 times. Like, is it worth it for that if it's also being valued as an AI company?
I think there's a couple of things that the investors are focused on beyond the second quarter. They did pull ahead the start of production for a more affordable EV from like the second half of next year to the first half, which is critical. I think the EV market today globally is actually, consumers in the EV market are actually looking for a more affordable EV, something that's less than $50,000 US. Most of the EVs offered today are above $50,000. So I think investors are hoping that into 2025 and into 2026, we're going to get a rebound in EV sales because there's going to be more affordable EVs, budget-friendly EVs for the mass market.
Steve, Tesla right now is an auto company, and it's an other company. Elon wants you to focus on the other. Can you define what's in that other bucket and when investors believe it will be material to their revenues and profits?
Yeah, he talks about AI quite a bit, robotaxi, the Optimus robot. But if you think of AI, I think there's, potentially even more ways to generate revenues from AI. One of the things that I think the market is also focused on, other than robotaxi, taking a passenger from point A to point B, is, for example, these cars have huge battery storage capacity. Right, and these things, if they can move about on its own, you can really help out the utilities in terms of redistributing power across the grid.
Well, to that point, their energy business was actually quite impressive. It had its highest installation of batteries and revenue ever, and energy accounted for just 12% and 16% of Tesla's revenue and gross profit, respectively. It's going to fluctuate, but that's pretty strong.
Yeah, it's a good sign. I think those tend to be a little bit lumpy because the orders are big, and so whenever they deliver the order and whenever they book it, that tends to be lumpy. I think we'll have to see if it's going to be consistent. But I think the investors are very focused on the auto business. When are they going to roll out the new? Are they going to be on time in rolling out the new EV, the affordable EV? And then longer term, it's really AI. Is he going to deliver? What is he going to say in October? The AI event that he's hosting. There were a lot of questions about that during the call, but they were pretty tight-lipped.
So, what is that October event? Can you tell us what the company says it is and what you think it may be?
Ooh, good distinction.
Yeah. Yeah, I think for the most part, it's going to be, what is this new vehicle they're launching? I think investors will be focused on what is this new vehicle? What is the price of this vehicle? How are you going to manufacture it so it further cuts, per unit costs? The other one is the full self-driving system that they're trying to roll out, the robo-taxi that they're trying to roll out. I think people are going to be focused on when is that going to generate, material earnings and material revenue. Now, I think it's not going to be until 2030, but I really think the other thing that's going to get people really excited is the Optimus robot, because the Optimus robot, they really haven't talked too much about it yet. I don't think it's going to get to 8 billion unit sales anytime soon. But if they can incorporate those Optimus robot into their manufacturing, I think there's going to be a lot of potential for cost cuts.
Okay, so the addressable market isn't John Tucker buying one. The addressable market is Musk using them to build a car.
That's right.
Oh, okay. So don't worry, John Tucker. You're not.
Well, no, I'm disappointed now.
Oh, bummer.
I was going to have it do everything for me.
To this point, if John Tucker wanted one, could eventually he actually buy one?
No, I don't think so. He doesn't. It's not for sale right now. I think what he's going to try to do is, build this robot, optimize this robot, within the confines of Tesla first. They're going to make it good enough, then they're going to offer it to the public.
All right,
but
so maybe
again,
just not yet.
that's going to be not soon. That's
right,
not
yeah.
Be soon.
So you got to wait.
Yeah.
You got to wait, John
Yes.
Tucker. All right. Steve, thanks a lot. Really appreciate it. Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst. You have to wonder, just people on the call being like, really? Addressable market is everyone on the planet?
Yep.
I don't know. That
Well,
seems
just
a little
look at
bit
the
pie in the
stock.
sky.
I mean, from starting the year till the third week of April, the stock was down 50%. Since then, up 75%. So, I mean, it's just, do you buy off on all these other bets outside of the car business where you have to bet metal, or don't you? And that's
and then how do
but
you
that's
value
always
that?
been the case
It's
for
true.
Tesla story. You have to believe in Elon. That's simple as that.
But it's going even bigger and bigger as the other gets bigger and bigger with
Yes.
more stuff.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. Happy Wednesday, everybody. Happy Hump Day. I'm Alix Steele alongside Paul Sweeney and John Tucker. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. So John Tucker laid out the market decline perfectly. And my really silly question is, well, why are stocks down? And I say silly because you can say, oh, of course, Google, Tesla, they disappointed, therefore stocks are down. Is that it? Or is it a continuation of last week and the rotation theme is still intact? Is there something else going on here? Bill Dudley talking in a Bloomberg Opinion article about how he changed his mind. He thinks that a cut should come in July because employment doesn't look that good. So let's get the read here with Kim Forrest, founder and chief investment officer of Bokeh Capital Partners, joining us from Pittsburgh. Kim, it's a dumb question. Why are stocks down so much?
Okay, I'm gonna answer it with a dumb answer. Are you ready?
Yeah.
Because there's more sellers than buyers.
No, I love this answer, actually.
I know. Well, I learned this on my very first day at Parker Hunter when I was a sell-side analyst. That's how one of the radio announcers would say, Parker Hunter. Anyhow, yes. And they didn't cover this in an MBA program on valuation, but when people get afraid that maybe they've paid too much for a stock or maybe that things aren't going the way they think, they sell. And selling makes stocks go down because when there's more sellers than buyers, the prices fall. And that is why we love markets, because it does the inverse. When there are more buyers than sellers, prices go up. But the fundamentals really are, is everything okay? And it looks like some things are okay and some things aren't. And it depends on what day the market thinks more of one than the other.
What do you make of this whole AI trade in the marketplace? Certainly was a theme, not just for tech companies, but for the whole market beginning in 2023. How do you view it? Because, again, we've had Tesla talking about it last night, Google talking about it still.
Well, I have a nuanced view because I was a software developer in companies that actually developed neural networks and then used neural networks. So, and that is the underlying technology that's behind ChatGPT and autonomous driving and all of that kind of stuff. So here's the skinny on that. I strongly believe the moment for AI is finally here because computers can be fast enough and we have enough of the right data to be able to train models. But investors are always impatient with new technology. And they thought, just like they thought autonomous cars were just around the corner in 2016, they're not. It always takes longer to develop really good technology. AI is really good, but it's not going to pay off in the next 15 to 20 minutes. So investors are becoming aware of that right now, especially as Google kind of outlined its spending plans that go on for the foreseeable future.
Well, that's where I think that question then goes to my first question of why stocks are selling off, and that basically they have to spend to then monetize, and there's going to be a gap between the spending and the monetization, and there's still a race to spend. And as an investor, how do you value something like that?
Well, in my mind, you don't yet, right? I don't know what Google is going to be able to monetize because we're not clear what problem they're solving. Like, that's the first thing we have to ask. What problem are you solving? Is it worth solving with technology, and how much money will you get? And we don't have any of those answers. But we do have this idea that AI is going to work out. So how we play this is we've been buying the semis and then storage companies or semis that have to do with storage because we know AI takes tons of data, unbelievable amounts of data, probably more data than it takes electricity. I mean, I can't emphasize how much data is needed. Okay, I think I've overdone that. But that's what we've been doing. So we buy companies like NetApp, which makes storage, enterprise storage devices, and then Micron, because they make one of the elements of storage, which is called NAND. It's a technology, a chip that you can store things on. And that is how we've played it, because we don't know what time frame we're going to be in. We just know somewhere within the next 10 years, AI is going to be a thing and show productivity, and people will pay for it.
Outside of technology, Kim, are there areas that are interest you?
Oh, all of them are interesting, honestly. You know, energy is a big question mark because it's been kind of unloved as we've done the move towards green, and now we're kind of going, maybe we need, you know, energy for a while longer, you know, the old-fashioned kind that we dig out of the earth. That's kind of interesting. And I think if we're going to be in a declining interest rate environment, maybe things like housing, and then ancillary areas around housing like home goods and that sort of thing, you know, items that people buy when they buy a new house, that might be interesting. And again, these are kind of 3 to 5 year time periods for us. We don't ever really want to make bets on the next 6 months because anything can happen.
Right.
So we're always looking out 3 to 5 years.
Which brings me, though, to the election, Kim, because I appreciate that you're not going to trade around the election, but there are some policies that feel binary, and energy may be one of them in a Trump versus Harris world, which would then affect investment and returns and prices in the next, say, 3 to 5 years, which is your time frame. How do you wind up thinking about it?
Sure. Well, I'm kind of a realist too. As much as you would like the world to be driven by renewables, it's not practical. It just isn't. If you look at any of the numbers, even as the use of renewables have gone up, so too has the use of non-renewables, right? So I think if you know, sure, the scale may be tilted towards renewables. Maybe you play it by finding a company that does both. And a lot of the energy companies are trying to get a green footprint somehow. So I think that might be where you look.
Fixed income, Kim, how are you guys allocating to fixed income these days? Because, you know, folks can sit into your treasury and get darn near, 4.4%.
I know. Well, we're short. We're still in the short term, right? Like whenever I have to replace a bond, I'm trying to go as short as I can to get the highest amount. And 2 to 3 years is where we're liking to buy. Anything longer than that, I don't know. It just seems too risky because it could go literally either way now, right? If we're going to reinflate, if the curve is going to go back to normal, maybe long-term rates will go up a bit, short-term rates will fall. So let's live it up and buy some short-term rates because we don't trade them. We just let them expire, right? So we're buying the yield.
So
to maturity.
Before we let you go, let's get into the debate about small caps. Do you say yay or nay to small caps?
I am a big yay.
Okay.
I have about half of my portfolios in small, I would say mid cap. I can't really look at anybody less than $1 billion. I don't have the temperament for the companies that live there. That being said, those high quality small companies often get bought by larger companies. And that's kind of what we're looking for is companies that have a really great track record of making products that their clients love. And a lot of them tend to get bought out, and it really does add a boost to your returns. So that's what we look for.
All right. Good stuff. Kim, we appreciate you. Thank you very much. Kim Forrest, founder and CIO of Bokeh Capital Partners, joining us on that. Okay, yeah or nay. But it's interesting. It's an M&A play. It's not like a Fed cutting play.
Right.
It's not necessarily a rotation play, but a takeout play. So that's also quite interesting.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We bring you all the top news in business, finance, economics, and earnings through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. And now is our great time. We get to focus on Google, aka Alphabet. That stock falling the most since February 26th and hitting its lowest level since June 18th. This is really hitting it, the earnings from yesterday. So Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, is joining us now in studio to dissect it. So on the one hand, we have the CapEx spend, and the other hand, we have the YouTube stuff. Which one do you want? Which is the bigger driver of the downside today?
CapEx. I mean, simply because this quarter, companies are not getting a pass on boosting CapEx. That wasn't the case last quarter, but clearly, I think investors are wary about how much CapEx these companies are going to throw on AI. And look, in the case of Alphabet, there is revenue in the cloud segment. So they quantified the AI impact on cloud, which was high single-digit contribution to cloud segment. And cloud segment actually saw an acceleration in top-line growth. But YouTube miss, I think I attribute that more to softer spending outside of financial services and retail, like sectors like automotive. They're not spending on digital ads right now because the sector is going through a cyclical downturn. So there is that cyclical element to YouTube's business, but I think there are a lot of positives. Core search growing at 14%. I mean, think about the scale of search and the fact that they are able to grow double digits. That's quite impressive. And that too at a very healthy margin. I mean, the biggest fear for this company was margins are going to get degraded because of AI and whatnot. That we haven't seen that. So a lot of positives, but clearly CapEx was an overhang.
All right, I've been making a point today. If any team deserves the benefit of the doubt of higher CapEx, it's Sundar Pichai and all the folks at Google. Stop whining about CapEx. Have they ever not generated a return on their spending?
I mean, the problem with Google's management team is they say very little on the earnings call. Like even when you answer them, ask a question, they would answer it with as little words as possible. So, it sounded like they are bullish on their AI opportunity and it's actually monetizing. Some of that CapEx is going towards Waymo. If you think about, robo-taxis and what Tesla had to go through their call last night, Waymo actually did 2 million rides year to date. And these are all autonomous rides. And they're expanding to other cities. So think about, the scale in that business if they're able to do actually autonomous driving successfully. So I do think their CapEx is well spent, but they just don't explain it that well to the street, to get the credit.
So when it comes to then the AI spend, what other companies are going to get judged in the same harsh light? And what's Google's one-up on them, if any?
Meta. I mean, you saw a negative reaction with Alphabet.
Yeah.
I mean, think about what will
Meta's
happen.
going to be worse.
Meta is going to be worse. Even last quarter, when they raised their capex, Meta had a negative stock reaction simply because investors are concerned about how much this company is going to spend on metaverse versus AI. And so in the case of Meta, they're losing $18 billion a year on Reality Labs. They're spending capex in addition to the AI capex, which they launched a new large language model. And to my mind, any company right now with their own large language model, whether it's Alphabet, Meta, or a Microsoft OpenAI, they have an advantage. They have the best reasoning capability when it comes to the AI spend, and it's actually a future driver of revenue. So it all comes down to how they are going to monetize it. And I think with Microsoft and Google, they have an advantage because it shows up in the cloud revenue. In the case of Meta, they have to monetize the AI spend through ad revenue or a subscription-based chatbot offering, which nobody knows when that will come.
What is Gemini? And John Tucker and I be using it.
Well, it's a better way to search for certain type of queries. So whenever you want, something with a detailed answer as opposed to going through 10 blue links to find that answer, Gemini is great. The one good thing about Gemini is when you search for a query, it's going to show you the relevant YouTube link. Whereas if you search that on ChatGPT or Claude, it's not going to have that YouTube link. So it's going to generate the text, it's going to generate a summary, it's going to answer your query, but it won't have that appropriate YouTube link. And that's Google's biggest advantage with the large language models.
Do I have to pay for that?
Yeah, it's a $20 subscription for the advanced version.
That ain't happening.
But some people will. I think that's kind of...
And that's where, you are not... you don't think it's a big deal, but I think Google owning Maps and YouTube is such a big deal in this arena of large language models because it's one thing to generate a text-based response. It's another thing to have a blue link with the YouTube video that they want you to see or the map link that they want you to click on inside that response. And other large language models can't do it because they don't own these assets. So.
All right.
Well, before I let you go, one thing though, about the Meta is that if these companies though don't spend, then at some point when all this is monetizable in a big way, all of a sudden everyone's going to complain that then Meta's super far behind. So what's the chicken and the egg here?
I mean, I still think nobody wants to be the first one to pull back on capex. So it really is a question of when do we have sufficient supply of GPUs? And because the market is supply constrained when it comes to the chip side of the equation, nobody wants to come across and say, oh, I have enough and I don't need to spend on capex anymore. And I think right now these companies generate so much cash every year. Like Alphabet will generate over 100 billion in free cash flow. So they can afford to spend 60 billion in capex. And they're looking to make a $23 billion acquisition that fell through. But clearly, they want to spend their free cash flow.
Which to your point,
Yeah, go ahead.
You earned it.
Yep.
Spend it.
Yep.
All right, Mandeep, you're the best. So helpful. So great. I asked him if he slept. He said yes, but I don't know if that's entirely true.
Kids at home too to make it even worse.
I know. But he was on late yesterday, early today, and all that stuff. All right, Mandeep, the best. Mandeep Singh, Bloomberg Intelligence, senior tech industry analyst. It's I feel like investors want both. They want the growth and they want the company to be profitable with it, but then they don't want the capex spend. It's dude, you can't have both.
Yeah, but then you got analysts like Dan Ives who just says, you pick the management teams, you pick the technology, and you just go. And you just got to shut your eyes and, not worry about the peaks and valleys. And you think about Tesla, again, first quarter through the third week of April, down 50%. Only to bounce back 75%. So you got to be ready for those roller coasters with these tech names, I guess.
Yeah, but then the problem with Tesla is that at least I feel like it's clearly laid out if you're listening to a Google conference call. The problem with Tesla is when he says something about a robo-taxi and Elon Musk says our solution would work anywhere, even a new Earth. What? I don't understand. They're all these, it's Elon Musky stuff, and that must be very difficult.
There is that Elon Musk risk
stuff
that you take.
Or Musky stuff, as I am saying it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio doing that streaming thing on the internet. YouTube.com, search Bloomberg Podcast, and that's where you'll find us. Let's talk commercial real estate because I have no idea what's going on here. I need to see some price action, price discovery out there in the marketplace. If I'm going to buy an office building on 3rd Avenue in Manhattan, what kind of discount am I going to get? Fortunately, Abigail Doolittle knows a ton of people in that business. Abigail Doolittle is a markets reporter, but she's wired into that commercial real estate business, which means the whole Morgan Stanley real estate mafia alumni crew. One of them is Sonny Kalsi, co-chief executive officer for BGO. I said, who is BGO? They got $85 billion in assets under management. What rock have I been sleeping under? So these guys are big. Sonny, thank you so much for joining us here in our studio. Abigail, thank you so much for joining us as well. Sonny, all I know is I walk down 3rd Avenue in a lot of empty buildings, and I'm just wondering how representative is that of the commercial real estate business. How do you guys view the commercial real estate business today? It's got to be like something you've never seen before.
It is something like we've never seen before. And you'd think after 34 years you see everything. And we always get asked to compare cycles, and every cycle is different, and this one is definitely different. I'll answer your question in a second, but the context around it is you just pick the asset class that's been hit the worst in the last 4 years, right? 2 years of a pandemic, call it, where people were working from home and a bunch of other stuff, and then you've got it piling on in terms of kind of bad secular news for the office sector, right? Work from home was one problem. I'm a real estate owner, so I think it's a problem. Work from home was one problem, which never would have happened without technology like Zoom. But then you have AI, you have a bunch of other stuff coming, which are all going to come after jobs, presumably. Office in gateway cities, like New York City, is probably if you want to take about lower left, if that's the bad place to be, that's the bad place to be, right? I do agree when the baby gets thrown out with the bathwater and they say all real estate is bad, people focus on that because it's kind of what's present, right? Abigail and I were talking about how the streets and out here and the retailers are all empty that used to be here. That's what you see, right? What you don't see as much is people are still living somewhere. You still get your goods and services somehow. Those are coming to you from a warehouse somewhere as opposed to coming to you because you're going to a store. Not that those have been immune. Right. But office, it's been tough. And honestly, I don't see it getting better in the near term. Well,
then to that point, what part of real estate is cyclical versus secular?
Yes.
So the warehouse point you make, that has to be a secular shift, but we're still in a cyclical market. So that's got to be very tricky.
Correct. Yeah, well, so I would say, as I think about investing, I think about the 4 quadrants. And people think about debt, equity, public, private. I actually think about cyclical, secular, and headwind, tailwind, right? So if you think about what's in secular decline and has secular headwinds, office is the best asset class to think about, right? All the top-down news is bad, the bottom-up news is bad, capital markets are bad. In terms of what has cyclical tailwinds, right? What has cyclical tailwinds and secular tailwinds? Anything related to technology. So I'm sure you've had a lot of people come in and talk about data centers. We have a big data center business too. It's been great. The issue is it's no secret that it's great. So there's a lot of money piling in, there's a huge amount of demand, which is what makes great cyclical opportunity. I think where we actually do our job, where we can be in a position to make the most money, is places that have secular tailwinds and cyclical headwinds. Right now, most things have cyclical headwinds right now because of the capital markets. When you ask Paul when things are going to come back, until credit comes back into the market, we're not going to see it. But right now, it's a great time to be in warehouses. The secular tailwinds are still pretty good, but it's expensive to build them, it's expensive to buy them. And so if you can figure that out with data, with anything else to kind of get an edge, that's good. Housing is the best bet, in my view, right now. And this is a U.S. comment. Half of our portfolio is U.S., half is non-U.S. People have to live somewhere. We have a structural housing shortage, but we have some issues. And so to me, it's actually the really interesting place to be.
Well, speaking of your portfolio, it's not all bad, because right here over on Park Avenue 425, I've walked by that building many times. It's the new Citadel building. It is absolutely beautiful, and there is the Bentall Green Oak stamp right on it. You know, when we think about this pain, though, it really comes back to rates. And you've had, we've stayed in touch, and I know that you had a great call on rates that back in 2021, 2022, when the Fed forecasted or telegraphed that they were going to raise, you took a particular view. Bond traders didn't do this. I know a lot of other commercial real estate investors that were more the hopium. Talk to us about what you were seeing, what you did, and what it meant for your portfolio.
So I think, and again, I'm not an economist, but my philosophy has always been you can do nothing about what you can't control. So focus on what you can control. We can control the rate environment. So when the Fed raised rates, and they did it at the pace they did it, and at the the slope at which they did it, our view was we couldn't count on when they were going to come back down again. Right? That was, and so what did we do? We invested against that. Now part of it is, why did we think they were doing what they were doing, right? And I think a lot of people focused, what I would say, on the demand side. They focused on cash. They talked on central banks that pumped in, COVID money, all that stuff. We actually focused on the supply side. The benefit of having a big global industrial portfolio is we see throughput. We have a big business in Asia. We saw China shut down. The world's largest manufacturer shut down for 3 years. It's a little bit of a statement of hyperbole, but they shut down for 3 years. Our view was you are not going to get back to normality until China reopened. China didn't reopen until the end of 22, beginning of 2023, after the 5-year Congress. So until that happened, it was our view that you weren't going to see stuff come back to normal again, right? Whatever normal is, by the way. And so the way we kind of thought about it is we're going to ignore it. There are a lot of people that are trying to invest against, hoping interest rates would come down quickly and then bet against that. I have too much scar tissue from too many other cycles.
Would you buy a Third Avenue office building today at 30 cents on the dollar?
I think there are plenty on offer, and we haven't bought any yet.
Okay.
All right. At some point, it will get interesting. I think the issue right now, back to the cyclical secular thing, is there's so many headwinds to office right now.
Yeah.
And
what about conversion?
So conversion looks great. Theoretically, it sounds great theoretically, but if you talk about one of those Third Avenue office buildings with a 40,000 square foot floor plate, and you try to actually cut that up into an apartment, people are going to be living in bowling alleys, right? And that's basically, if you just visualize it. So actually, conversion worked great downtown after 9/11. A lot of stuff got converted, but those are older buildings with better ceiling heights and other stuff. They converted a lot to multifamily and a lot to hotels. Bigger windows, everything.
Silly as that sounds, but yeah.
Yeah, people never used to live on Wall Street. Now people live on Wall Street, but that's why. Look, it's going to be a slow grind.
So when you say office buildings, Paul was saying 30 cents on the dollar.
Yeah.
I get that we're still in the headwind place.
Yeah.
But is it like 15 cents on the dollar? You're like, oh, okay, fine. Like, when does it become a valuation thing?
It becomes a valuation thing when you have some degree of conviction you can lease that space.
Okay,
right?
so it still has to come back to the fundamentals.
It has to come back to the fundamentals, right? That has to come back to that, number one. Number two, the financing markets are upside down for real estate. There's news today about that.
You've got banks that they kill for your business. They wine and dine you for 30 years. Now you go back to them and says, now I need the money. Well, I can buy this B-plus property on 3rd Avenue for 30 cents on the dollar. You know this is a good deal.
Right. Well, look, first of all, many managers of our scale are both on the equity. So 20 billion of our 85 billion, we're a lender.
Okay.
All right. So we have a lending business. So all the pain I am seeing our lenders bear right now, we bear as a lender as well. So that's complicated. The regulators, Basel III, there are a lot of headwinds against banks, regular way banks coming back into commercial real estate lending. That's why the private markets have exploded the way they have, and I think our view is that they're going to continue to be really robust. But the problem is a first mortgage on 60% loan to today's value that costs someone 9 to 10% is not a normally functioning capital market. It's just not.
Well, to pick up on something that Alix and Paul were just asking about relative, and Alix in particular, the valuation. So Yigal Namdar, not so long ago, went even further. He was saying some of these buildings, you could get them at less than 10 cents on the dollar. He was saying he thinks it's the bottom. It's hard to not think that's the bottom, but so many people that I talked to, so many of my sources, this is the one point of agreement as to whether how much pain there is ahead or not, that it's going to take a long time to work out. So how long do we just skirt along the bottom?
We just have about 20 seconds.
Well, if we're just talking about office, I'm not sure we're at the bottom yet.
Okay, that's kind of
that's interesting.
Yeah, I don't know. Until I start seeing some of these things on Third Avenue start trading in the comparable place in Boston and San Francisco, we'll see. Sonny Kalsi, thank you so much for joining us. Sonny Kalsi is the co-chief executive officer BGO, and Abigail Doolittle, markets reporter for Bloomberg News, joining. Talking a little about commercial real estate. You can't put it all in one bucket. It's not all office. It's a lot of different stuff out there, but office is tough, like keeping track.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get more now on the money behind this race. Max Abelson joins us, Bloomberg News Finance Reporter, on an article about the get-rich-quick ideas. I was going to call them schemes, but they're not ideas. They're not schemes. They're ideas from Wall Street donors. They need to raise money fast for Vice President Harris.
Well, first of all, I have to give a shout out to the journalist who's really responsible for this work, who's Amanda Gordon, my friend and colleague, who's been reporting on the rich people who love Donald Trump, the former president, and the rich people who want to make Kamala Harris the next president. And, listen, I don't want to give the wrong idea. I mean, wealthy Democratic donors on Wall Street have been, putting a lot of money into the effort to reelect Biden. It's not as if they had closed their purses and their wallets, and then all of a sudden they're opening it up. But I think what Amanda's journalism highlights in a really vivid way is that they are going strong and they're going hard and they don't have a lot of time to raise this money. And when I say they, I want to be clear that we're talking about essentially the creme de la creme of Democratic donors. You've got, do you all know the name Blair Efron?
Sure. Yeah.
Yep. Centerview. I mean, you got Brad Karp. Brad Karp is technically a lawyer, but I think there's a part of big law that's essentially an extension of Wall Street. You've got Mark Lazary, Ray McGuire, who I wrote a profile of for Business Week back when he was running for mayor, if you all remember that. It's funny at Blackstone, obviously the most important donor inside Blackstone is Steve Schwartzman, who's giving a lot of money to Republicans. But don't forget, Blackstone's John Gray is there to, I don't know if he's essentially probably, I'm assuming not wealthy enough to counterbalance Schwartzman, but still a lot of money. The list goes on. Peter Orszag, Roger Altman. These are the people who've been at the highest levels of Wall Street's kind of Democratic caucus for a long time. And you just sense a lot of excitement about Harris, and they're going to be spending a lot of money.
It's interesting because I think Wall Street and just business in general is trying to get a sense of these early days. What would a Harris presidency mean for business? Would it be good for business? And I see Amanda quotes Jim Cramer in here telling investors on CNBC Wednesday that a Harris win would, quote, absolutely, no doubt about it, end quote, be good for U.S. businesses.
Only Jim Cramer would say no doubt about it, when, of course, no one ever knows what the future holds. But, speaking of business, I think it's important to pause and to remind our listeners that, Donald Trump, we know what Donald Trump will do for the business community, and let's talk about it. I mean, the big news is that he likes low taxes, and I mean low corporate taxes, and then low taxes on wealthy people. He also has pledged to deregulate, and he has shown that he wants to. That's why you have real enthusiasm for him on Wall Street. Howard Lutnick, John Paulson, Woody Johnson, John Katsimatidis. There are really, really deep wells of really rich Wall Street executives who want this guy to win. Omid Malik, they've been raising money for him. They're going to be raising money for him. I don't want listeners to think that when Wall Street looks at the 2024 presidential election, all of their money is going to Democrats, because that is not the case. Oh, yeah. But I think that there is a really big part of Wall Street that looks at Kamala Harris with a kind of optimism, with a kind of optimism that she gets them, that she understands them. I don't think they look at her the way that they would look at Bernie Sanders or Elizabeth Warren as a sort of, this is a loaded word, but as a kind of enemy. I think they look at her, maybe the right way to say this is, as a potential ally.
Well, I mean, Bloomberg's been reporting that the Harris campaign pulled in $100 million just from the announcement through Monday evening, and presumably that's from smaller donations as opposed to pulling in some of these Wall Street.
It is from smaller donations.
Well, I was going to say to that point that it also is from new donors, not just smaller, but new, which also raises the question that she would be the first woman and the first Indian American to be elected president. Obviously, President Obama was African American, so she would not be the first African American. And the idea is that hope going to bring in a lot of new donors that otherwise wouldn't have donated, even on the high end?
Yes. Listen to the statistic. Listen to the statistic. You ready? There were 1.1 million unique donors. Not 1.1 donations, 1.1 million different donors who contributed in that, what was it? It was like 36 hours after she announced. 2/3, not fully 2/3, 62% giving for the first time.
Wow.
But no matter how many small donations she gets, she's going to have to raise a lot of money, and she's going to have to do it quickly. So I think the way the landscape looks is that she's getting support from like a Barry Diller, a literal billionaire, and she's going to need support from those 1.1 million unique donors, practically 2/3 doing it for the first time. She is going to be embracing, I think, both of those. Although, obviously, I'm pretty sure that when it comes to publicly bragging, she's going to be publicly bragging about those small donors and not publicly bragging about the billionaires.
Well, on Saturday coming up, Harris is scheduled to appear at a donor event featuring the performances of James Taylor, Yo-Yo Ma, and Emmanuel Axe. It's like an episode from The West Wing.
I mean, shout out to Yo-Yo Ma, though. I love the Bach cello suites.
Really funny.
But don't you want somebody who's more in tune with, the younger generation?
Well, she also came out yesterday to Beyonce, which she had full rights to use. So there's also that.
Yo-Yo Ma.
Yeah. No. Well, yesterday was Beyonce. You gotta have this is Max's point, is you gotta have the different levels.
Well, her husband's also in the game. He will attend several fundraisers next week, including an event in Martha's Vineyard featuring comedian David Letterman.
Listen, the kids love Yo-Yo Ma, though. I'm telling you.
Yeah.
They do.
Not my kids.
Good
Well, also, I guess, what are you trying to appeal to? Are you trying to appeal to the kids? Are you
who's
trying to appeal
Emmanuel
to the
Axe?
base? So you're trying to appeal to heavy donors? What is that goal when you're coming out to Beyonce or Yo-Yo
You're
Ma's
trying to
gonna be
appeal
there?
to the voters, the younger voters especially.
Can I answer
that?
I want to answer the question, though. Emmanuel Axe?
Yeah.
Really lovely pianist.
Okay.
You should have listeners tune when you're not listening to Bloomberg Radio. Listen to some Emmanuel Axe.
There you go.
Great pianist.
I do love Yo-Yo Ma, but then again, I don't think I'm the young kid. So there's that.
But it's a good metaphor, though. It's a good metaphor. She's going to want Beethoven listeners and Mozart listeners, and she's going to want Beyonce listeners. And in a way, it's kind of a good simile for
How about the
these donors.
Swifties? Where are the Swifties at? Can I get the Swifties? That's a big cohort.
So actually, funny you say that. Michael McKee has been texting a group chat that we have kind of nonstop as to who Taylor Swift will endorse. Will she endorse Kamala Harris? And will that, move her away from some any MAGA attendees? And I'm trying to be like, dude, chill. No. It's not going to happen.
All right. I mean, she's
Those fans won't ditch her for Harris. Yeah, we're good. Anyway, much more coming up. We're going to talk about the state of commercial real estate. Hey, Max, really appreciate it. Max Abelson joining us.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.